ideally, you as the founder of the company, you're figuring out with investors, whether that be angel investors that are going to come in and anchor the round, or maybe your board, or advisors, or maybe speaking with other founders. Okay, what are the right terms? Are we going to do equity or debt? If we do equity, is it a priced round? Is it a safe? Is it a convertible note? If it is a loan, like is it a revenue-based financing deal or a standalone with a fixed interest rate? So we're kind of you are kind of figuring out the terms of the investment with the investors, and it's obviously got to be in line with market. Because if you say, we're going to offer a loan and we're going to pay investors back 3% interest, then no one's going to lend you that money, because they can get that from, investing in a big company that's not risky. You have to figure out the right terms of the investment with the investors, then whether that's debt or equity, and then we put that up on WeFunder.
What's up, you guys? Welcome back to the More Rounds podcast. I'm Kim Lewis, CEO and co-founder of CurlMix. Here on this podcast, you can learn about how to fund your business, whether it's raising money, whether it's figuring out how to cash flow it, or getting debt. And today, you guys, we have none other than one of my favorite people, Jonny from WeFunder, who's VP of fundraising. Jonny helped me in my crowdfund, and I am so excited to have him here to talk about how you can do a community round, okay? All right, so before we get started, let's do a cheers. Cheers.
Cheers.
Okay, so Jonny, tell me about yourself. Tell me about WeFunder. I'll let you go ahead and go.
Sure. So Jonny Price, as you say, VP of fundraising at WeFunder. As you can tell from the accent, not from Georgia, not from Tennessee originally, but from England. So he grew up there and then came over to the States initially to volunteer for a nonprofit called Kiva.org. It's based in San Francisco. While I was there, I met my wife. We're happily married, been married for about 10 years. We've got three beautiful young kids. We live in Nashville, Tennessee now. So I lived in SF for 10 years. Now we live in Nashville. And yeah, WeFunder is a platform that helps founders like yourself raise capital, not just from rich people, accredited investors, institutional investors, but also from their customers, from their community. We call it a community round. It's using a relatively new law that passed Congress about 10 years ago. The SEC rolled it out in 2016. It's called regulation crowdfunding. And so this allows you to raise capital from unaccredited investors as well as accredited investors and publicly promote and market the raise. So look forward to talking more about it today.
So Jonny, there are people out there who are like, I don't know what it means to raise money from investors. Mm-hmm. I'm not familiar with that. Should I be doing something like crowdfunding for rewards, or raising money from rewards just for or should I be doing it for equity? How do you define what kind of business should be one that is looking to just kind of get donations from their customers versus like selling shares in their business?
Yeah, so there's different types of crowdfunding. And as you know, we don't love term crowdfunding. We talk about community rounds. So every time you talk about crowdfunding with respect to WeFunder in this conversation, I am going to charge you 25 cents in the swag jar.
Oh my gosh. All right, these startups and their branding. My bad. Okay, community rounds, you guys, not crowdfunding.
But so people call it investment crowdfunding. So we do investment crowdfunding, and there's different types of crowdfunding. So Kickstarter is the one that people know, or Indiegogo is another type of perks-based crowdfunding. And then there's donations-based crowdfunding like GoFundMe. So with Kickstarter, you might say, okay, I want to raise some money and I'm going to give you a perk, which might be a t-shirt or a discount on the product. Did you ever do a perks-based one for CurlMix?
No, and I probably should have. It seems so elusive, right? It's like, throw your product up there and see if people will give you money to launch it. And it just was like, it just always felt too... unstable to me. I don't know. It's just weird. And maybe I shouldn't have, because I know that Brandon Sanderson, he basically raised like $40 million from his community, right? Through rewards crowdfunding, which I didn't know you could. I was like, oh, wow, that's really impressive. But it just seemed like, I don't know. It just seemed like not enough. I don't know, as a reward.
That's actually what I was going to say for me, like the big difference between like GoFundMe, which is donations, or a Kickstarter, Indiegogo, which is perks, is the amount raised. And so typically, if you're just giving a product or a perk, you can raise large sums of money. You have people that raise millions of dollars on Kickstarter. But the average Kickstarter raise, I believe this is right. You can check it on their website, but I think it's around 25K.
Wow.
And the average...
that's low.
Yeah. And there's a lot of, smaller companies that are doing it that way. And then the average WeFunder raise is about $500,000. So typically, if you're offering a rate of return to investors, then they might get out their checkbooks and write you a larger sum.
Gotcha.
The average Kickstarter backer, I think, is $80. On WeFunder, the average investment amount is $1,000. So typically, if you're looking at raising a larger sum of money, then investment crowdfunding and WeFunder is kind of the path you want to go. Just to say one thing as well on WeFunder, so most of what we do is equity, right? So you're raising from VCs and angel investors. Typically, you're raising equity capital. And so the hope for investors is that you build a huge company, you 10x, you 100x, and then their equity investment is worth 10 times or 100 times when you exit the company in a few years' time. We also do debt investments on WeFunder. So you can put your investment up and you say, I want to borrow money at 15% interest.
Is that new?
We've actually had it for a while. We had a brewery in Austin, Texas, Hops and Grain, raised $1 million through a loan back in, I think, 2019 or 2017 or something. So it's been around for a while.
Wait, how do you pay it back?
So there's a couple of options. So one is like a loan with a fixed term of like 5 years, and you pay an interest rate on that, like an SBA loan. Let's say.
I just put money in like my WeFunder cash or something as a business to pay them back, and then they get you guys distribute it?
Yeah. So let's say you raise $500,000 from 500 investors on WeFunder, investing $1,000 each. So that's a $500,000 loan, and every month you pay back whatever $5,000. And then we distribute that out to the individual investors.
I do not know that.
Yeah. So that's a kind of a fixed term loan.
I'm kind of mad, Johnny. I might have done that sooner if I didn't know y'all did that.
Well,
I didn't know y'all did that.
I think for you, an equity raise was the right one, right? I think investors are probably in CurlMix looking at getting a piece of the upside. And obviously when they're investing in startups, like it can be quite risky. And so investors are oftentimes like looking for that big kind of upside piece. So usually...
What happens if they can't pay the bill? Like, has that happened?
Yeah. I mean, it's like a business that borrows money from a community development financial institution or a bank, or, ultimately the business goes bankrupt and, the debtors are going to collect.
Okay, so y'all don't promote this. Y'all like, no, just do the equity, because in case you can't pay this back, like we don't want you to bankrupt you.
I think, for what I try to say is like, I'm not an expert in figuring out the right investment structure. I'm an expert in investment crowdfunding and the regulations and helping you succeed on the WeFunder platform. But ideally, you as the founder of the company, you're figuring out with investors, whether that be angel investors that are going to come in and anchor the round, or maybe your board or advisors, or maybe speaking with other founders. Okay, what are the right terms? Are we going to do equity or debt? If we do equity, is it a price round? Is it a safe? Is it a convertible note? If it is a loan, like is it a revenue-based financing deal or a standalone with a fixed interest rate? So we're kind of you are kind of figuring out the terms of the investment with the investors, and it's obviously got to be in line with market. Because if you say, we're going to offer a loan and we're going to pay investors back 3% interest, then no one's going to lend you that money, because they can get that from, investing in a big company that's not risky. You have to figure out the right terms of the investment with the investors, then whether that's debt or equity, and then we put that up on WeFunder.
So what do you say to people who are like, if you're crowdfunding, it means you weren't good enough to raise money from institutional investors, Yeah, I think that stigma kind of used to be more the case. I think... when do you think that was the case? Because I would argue that some investors think that now. You know what I mean?
Yeah.
They all look at me. Most people, when I told all of my advisors, I told them I wanted to crowdfund, and they all looked at me and was like, don't do it. They were like, and more than don't do it, it was just like, one of my advisors was like, it's not a matter of if you can do it. Kim, I know you can do anything. So you can do it, right? She's like, but is like that how you want to spend your time? And I was just like, well, what other options do I have? You know what I mean? Yeah. And so do I just be small forever because I can't raise money from institutional investors? Yeah. And then some people are like, well, the best deals nobody hears about, because people are quick to put their money in, and it wraps up very quickly, and it's not like this long drawn out process. So like, how do you respond to that? The best deals are actually not through crowdfunding.
Yeah, I love this question. For me, if I'm being kind of cheeky and combative, right? Yeah. Like, I think what WeFunder is doing for early stage investing in startups like CurlMix is what Airbnb was doing for hotels, right? rather than Hilton and Starwood and whatever, the Marriott, the big hotel chains, who kind of, we have all the hotels and you have to stay in our institutional corporate hotel. Now anyone gets to be a hotel owner, like on Airbnb, and it makes for a more diverse, it's kind of democracy applied to early stage investing, just as Airbnb is democracy applied to hotels. And yeah, the owners of Starwood and Hilton probably didn't think Airbnb was that cool, or they probably thought you needed the corporate, homogeneity of, Starwood, and Airbnb wasn't going to work. So for me, there's always going to be some, raised eyebrows and skepticism of the democratic model, just as probably the head of New York Times was, skeptical of, the Twitters and the Substacks and the democratization of journalism. But let me say, anyway, that's kind of where I think some of the skepticism might be coming from. For me, there's kind of two main answers to your question. One is, the best way to answer it from a kind of we can't raise from real investors thing is to do both, So if you look at like Mercury Bank, really awesome bank for startups, great product.
I actually have their card. I mean, I don't use it much, but I did sign up for Mercury Bank. Yeah. It's like $1,000 in that account.
Yeah. So their customers absolutely rave about it. Just like a very modern bank account that's like really, using technology to make kind of banking easier for you as a startup founder.
Yeah.
And so they raised 120 million Series B. I think it was led by Coatue.
They raised $120 million in their Series B. Okay.
From VCs. Andreessen Horowitz was in it. And then they opened up $5 million allocation to let their customers invest and filled it out in a day on WeFunder, massively oversubscribed. If you were a customer back then in 2021, you might have got an email about it.
Oh, I did not see that email.
So you missed it. You missed out on the chance to invest. I mean, it was gone like that. But the point is, any question about, like you did crowdfunding because you couldn't raise from real investors, for them, it's like, we just raised 120 million from real investors. So if you can raise from VCs,
right, and we say real as in air quotes.
There was a lot of quotes on the real there. But it's so if you can raise from institutional investors, VCs, and you want to, right? Not everyone wants to go that path. It kind of constrains you and forces you down a certain growth path. But if you want to go that route and you can raise, then do both. Have the VCs lead the round, price the round, and then also let your customers invest. And that kind of leads me on to the second reason for me of, what I would say on that kind of negative signal or stigma point. If you're a consumer-facing business like CurlMix, my pitch to you, and hopefully you bought it, that's why you did it, it's like if you let your customers invest, they're going to be more loyal fans of CurlMix. They're going to be passionate brand ambassadors. Their net promoter score goes up, their churn goes down, their LTV goes up. And
but what do you say to people who are like, this is me being devil's advocate, right?
Yeah,
I've done a community round and I'm actually launching another one. So like, I'm excited about it. I think it's the future of investing, right? Yeah. I think that this is not the way that venture capital is, I hate to use the word, but I think it's tainted. I think I don't think that is the way companies should grow. I think that was like a microcosm of how they got the Facebooks of the world and the Ubers of the world, but that doesn't necessarily work for most ways of growing companies.
Totally.
And so for me, and I think specifically for Black founders, equity crowdfunding or community rounds are like ideal because most of us build communities anyway, and then we just don't know how to monetize it. And this is kind of one of the ways you can do that. But what do you say to I was talking to a friend, she runs a fund, a $50 million fund. And she basically said to me, Kim, those investors don't know what they're doing. You're basically taking people's money and you're misusing it. How do you respond to that? And I'll just say real quick, the SEC regulates, equity crowdfunding and things like that, regulation. But like, I could go to a casino and spend like $20,000 of my life savings and no one cares. You know what I mean? So like, I don't know.
Yeah.
What are your thoughts there?
A couple of things. I think one is, I don't think we're saying you shouldn't retail investors shouldn't be able to invest in public companies on the stock market, right? So if they're able to invest in, L'Oreal, or Procter & Gamble, like why shouldn't they be able to invest in this brand that they love?
Yeah.
So
very true. That's
we generally think like retail investors should be able to, have access to these opportunities. And, and then in terms of, are they sophisticated? We always try to encourage founders to, frame the risks, highlight the risks. Investing in startups is risky. You should not invest more than you can afford to lose. We talk about this a lot on the website. We use the phrase of socially good lottery ticket. You invest in the lottery.
Socially good lottery ticket is basically community rounds. Yes.
Yeah, you invest in the lottery. You hope you have a big payout. You probably don't. But this is, you're investing in a startup that you believe in, a founder you believe in, and hopefully there's a investment return on it as well.
Yeah.
And if it's a VC saying that, then again, another kind of aspect of what we're doing is, a VC can lead the round, and then let's let the customers of that B2C company invest on the same terms as the VC.
CurlMix sells for $100 million to X company. Yep, that's the headline. And if you don't invest, you're going to miss out on that opportunity. Make sure to go to curlmix.com/invest if you want to become an investor in CurlMix. Now back to the episode. Do you think VCs are actually afraid of crowdfunding? Because it's such disdain, right?
Yeah.
I remember it was almost like a scarlet letter. You know what I mean? Like, oh my gosh, you crowdfunded, But then when they hear I raised 4.5 million or almost 5 million, they're like, oh wait, that's interesting. That, and some of them don't invest more than $500,000 or $1 million in each company. So the fact that you can raise 5 million on your own is kind of like, oh, maybe I should pay more attention to what she's doing.
Yeah, I think probably most VCs are not scared of crowdfunding. I think the CEO of Hilton was probably not scared of Airbnb in the early days of Airbnb. Because the CEO of Hilton thought that it wouldn't make sense for people to stay in the houses of people in different parts of Orlando. They all should stay in the downtown Hilton hotel. So I think that's probably one reason. But another reason is just very small, right? Regulation crowdfunding community rounds are still a very, very small part of early stage, like angel capital and venture capital. It's still very early. What I was saying before about the stigma is changing is you probably wouldn't have done a WeFunder campaign in 2020 because you only would have been able to raise $1 million. Whereas you did it in 2021 because now the cap is increased to 5 million.
Yeah.
And so Replit, another great example, raised 80 million Series B.
What is
Replit? That? It's a platform for basically bringing on the next billion software engineers. So it's a platform for community and helping engineers to learn to code.
Like GitHub?
Yeah.
Okay.
Similar.
Okay.
So they raised an 80 million Series B back in 2022 and then opened up a community round.
So much money.
Much money.
I just love when the big numbers 80 million, 100 million, 20 million, 50 billion, whatever, roll off your tongue.
Substack's another one. Substack, the newsletter platform, so they did a 5 million community round earlier this year.
How many founders have done community rounds on WeFunder?
On WeFunder?
Yeah.
1,000, 1,500.
1,000?
Well, that's
how
companies
many
probably.
Raise over 4 million?
Very small, maybe 2 or 3%. You are in an elite group, Kim Lewis.
You don't say.
But
that's rare for me,
The point I was making is only in 2021 when the SEC made some really important rule changes, 5 million caps, and now we can roll individual investors for one SPV on your cap table, one line.
What's an SPV?
Special purpose vehicle. So this is an instrument, an LLC, a company that's created for the specific purpose of rolling up these thousands of CurlMix
And when you say
investors.
Instrument, you really just mean it's a piece of paper that says WeFunder LLC.
It's actually a guitar. It's a musical instrument. Yeah, no, it's exactly. It's an LLC, a company that's set up, and then all of those investors, instead of being 1,000 lines on the CurlMix cap table, which is the list of all your investors that you need to maintain, it's just rolled up to one line on your cap table. And
I first learned about an SPV with you guys. I didn't know what that was. And I'm just explaining this to my listeners because I think most of them don't much about investing, right?
Mm-hmm.
So it's I want to find funding for my business. An SPV was literally a 3-page document that said, WeFunder is responsible for this special purpose vehicle, and it will all roll. All the investors who are listed on the cap table, CurlMix has 7,000 investors. We're going to have one person who's responsible for voting on that, which would be Lamar Tyler or whoever my lead investor was, and that in the event something happens to them, WeFunder would then appoint my next investor leader or whatever, and then they would vote on behalf. But essentially on my cap table, I could just have one person, which would be Lamar, for WeFunder. And that's what an SPV was, right?
Yeah.
Okay.
And this is very common in startup investing. If there's lots and lots of investors in a round, they're rolled up to one special purpose vehicle, one line on the cap table. It just makes it easier for you to manage as a founder going forward. And so the point is, before these SEC rule changes in 2021, we didn't have SPVs. And so again, you probably wouldn't have done WeFunder. The Substacks, the Replits, the Mercury Banks of this world have only really started to be interested in running a community round in the last couple of years.
Yeah.
And so it's still very, very nascent. And one thing that's interesting right now in this market, obviously the amount of venture capital sloshing around is a lot less now than it was in 2021.
Do you have the numbers around what kind of capital was available in 2021 versus what's available
VCs?
now? Yeah, from VCs.
We'll put a link to a Carter chart in the show notes. You have to have show notes, right?
And Carter is a platform,
podcast.
you guys, that basically, it manages your cap table. So it says like, okay, you have 50 investors. Here's where they can log in and see what kind of equity they own and any documents they need to sign, et cetera.
And so they have, I just was looking this morning, they have a report. I can't remember the exact numbers, but it's something like 60% would be my guess from looking at the shape of the chart, 60% drop off in venture capital from 2021 to 2023 VC dollars deployed. And
so that means that there were $100 million available. Now it's only like 40 million available.
Yeah.
So
and don't quote me on that.
1 in 3 companies are getting the capital that they would have gotten a year ago.
Yeah. And don't quote me on the 60%, but it's a huge drop off in the last couple of years, right? I think every founder is feeling this. There's a lot of down rounds, right? So maybe in 2021, you raised at a $80 million valuation, and now you're looking at having to raise at a $50, $60 million valuation because the market is down. There's less investor demand. And so you have to, raise on a lower valuation. So
flat is the new up.
Flat is the new up. Yeah. And so the point is, in this market where I think it's harder for founders to raise from VCs than it was a couple of years ago, more now are increasingly interested in saying, well, raising $5 million from my customers, turning those customers into super passionate brand ambassadors because now they're owners of CurlMix.
Yeah.
It's a very interesting option. And yeah, the more and more, have you ever read that book, Crossing the Chasm?
No.
Jeffrey Moore, great book, would highly recommend it. If you're like working on a startup disrupting an established industry, it talks about how you get these early adopters like Kim Lewis who do it. But a lot of people say, oh, this is a negative signal.
Oh, I'm an early adopter?
You're an early adopter,
oh, man, okay.
And basically, it's like confident.
You call me a hipster.
Confident, bold,
you were going to say brilliant and then you didn't say
brilliant. Confident, bold, brilliant, visionary founders.
The judgment. It's the Cambridge coming out. Well, that's what I think it is.
They will kind of take a risk on this like innovative model, and then over time, more and more founders will kind of say, oh, well, Kim did it. Kim's awesome. That was a great success story. That worked out really well. And the more case studies and examples there are, the more comfortable folks will be with doing it.
Did you have founders coming to you as like, well, Kim did it, so I want to do it too? And then were they able to do it? And if not, what do you think was the difference between a founder who like was able to raise the $5 million versus the founder who like couldn't raise $1 million?
Yeah, so there's
because I think people also don't know the work that goes into a community round,
Yes, Kim, you are very special.
I wasn't trying to say I was special. I really wasn't.
For the compliment.
Wow.
Yeah.
Wow.
You are brilliant. No, of course, like I mentioned, I think you raised $4.5 million.
And it was not. No, I sent people your way.
Yeah,
okay? I sent people your way, and they didn't. And I thought, okay, they have a large community. I thought they'd be able to raise, at least $1 million, and it didn't happen for them. And I'm like, well, dang, like, what did they not do that I was doing to raise that money,
So I think you raised $4.5 million, something like that.
Could have raised more, but side crash. But it's cool,
Hey, well, there's always a second bite of the apple, right? But I think, like I mentioned earlier, average raise when WeFunder is $500K. So you're like much above average. There's a bunch of things, right, that go into whether a company raises $5 million on WeFunder or struggles to raise $250K, right? Okay. Just as there's a bunch of things that go into whether a founder can raise $5 million round from VCs or whether they won't do that, right? So your growth rate, the total addressable market size, you as a founder, your bandwidth to...
But do you have like one metric? Like, do you ask founders like, oh, what's the size of your mailing list? And is that usually able to tell you like, oh, they can definitely raise the 5 or no, they definitely can't?
I mean, not really, because there are companies with zero audience that have raised, millions of dollars on WeFunder. And there's companies with large audiences that, struggle to raise, which is maybe what you were talking about. But I mean, certainly as you're getting at, like the size of your community is pretty important, right? And probably of everything, I would say that's the most important. It's not the be all and end all. And I think about the community in kind of 3 ways. One, how big is the community? So you get a huge audience. Secondly,
what's huge?
I mean, again, there's no kind of easy answers, but like, social media of 20,000, like email list, 50,000 is starting to get up. But
okay, that's it's great that we clarify that, because I would not consider that huge, but like you're like no for.
But again, it's a spectrum, right? So Mercury Bank, the company I mentioned earlier, I think when they did WeFunder, they had like 25,000 customers or so. So a much smaller number than, I don't know how big your email list, social following was, but that was a much smaller number than you. But they raised $5 million in a day.
Gotcha.
Because it's not just the number, but it's also like, how strong of a relationship do you have with your customers? And so typically CPG, actually, it's not that strong of a relationship, because maybe someone buys your product. Yeah, because like maybe someone buys your product, and it depends as well. Like maybe, I don't know how much people spend on CurlMix like every month or every year, right?
Yeah.
But like, if it's your bank, or if it's like a product that is kind of, I don't know, they're spending like $10,000 on and spending so much more money on, then they have that kind of closer relationship to the company. And so another one would be Net Promoter Score, right? Like, or your rating. Like if your customers really, really love you, then if you give them a chance to invest, they jump at the chance.
Gotcha. Okay. Are there any mistakes you see people make when they equity crowdfund?
Yeah, a ton.
A ton. Okay. Just give me the biggest one. The one you see time and time again, you're like, oh my gosh, I wish people would stop doing this.
I think like, raising on terms that are out of line with market. I think if I'm, some of our competitors, I see this maybe more, not to say we're totally immune from it on WeFunder, but like just raising on valuations that like no serious investor would ever invest in.
Give me an example. What's like a really bad valuation that you've seen? And you don't have to say you don't have to out the company, but
I saw a company raising on a valuation that started with a B for billion with $0 in revenue.
Are you serious?
Yeah.
Did somebody write them a check? Did they actually get money?
Yeah.
How much money did they get? You gotta give me a range.
I mean, they raised 7 figures. And I think,
wow.
And this is for me like
$1 billion valuation with no revenue?
Yeah.
That's crazy.
Yeah, so that's a mistake. And another one I see founders make kind of in the opposite direction maybe is like, it's a lot of work, right? It's a lot of work. Like it's a big marketing campaign. It's an opportunity. It's an amazing opportunity to run a great marketing campaign. Founders will tell us it's the best marketing campaign we've ever done, but like it is a lot of work. And so if you come into it, and this is another kind of related one, if you come into it and you think WeFunder is going to do all the work, right?
Right.
You think like, oh, I'll just put CurlMix up on WeFunder. I won't do anything. And then the WeFunder investor base is going to flood in and fund me $4.5 million. It doesn't work like that. Usually the amount coming from the platform is a minority of the amount you raise. So you got to drive it, whether that's your customers, whether that's pushing it on social media, whether that's trying to get it to go viral, whether that's like getting your friends and family, angel investors to invest. And then you'll get some money from the WeFunder investor base as well. I call it free money from being on the platform. Yeah. But usually it's a small percentage of the total. I
used to tell people that it's not that WeFunder is going to make or break your campaign. It's great to have a good platform, right? Yeah. That can do the thing is you can't raise the money yourself and take it yourself legally. You have to run it through some other platform. Yeah. And that's the benefit, is that they allow you to do this, because otherwise you wouldn't be able to raise from your community without the likes of a platform.
You wouldn't be able to legally, if you want to raise from unaccredited investors and if you want to publicly promote and market the fundraise, you have to use a platform. And WeFunder's the biggest and the best.
You know what was kind of wild to me? The SEC was something I always just kind of heard in the movies. You know what I mean? And it was like, okay, I saw The Big Short, and I know what the SEC does. Like they come in like, bring down the hammer when people are acting crazy. Yeah. But no, it's just like a set of guidelines and rules for how we buy and sell equity in businesses in our country, right? And so then there was something called like the Form C. Form C was like a long document with like accounting. And so this is my question, right? When you were saying that there are some founders who should and should not equity crowdfund, I was thinking that if you don't have your financials together, let's say you haven't had a bookkeeper for the last year, should you, and we didn't talk about the parameters, but if you're raising over, what is it, 600,000, what's the numbers?
So if you're raising up to 124,000, so WeFunder, the minimum we allow is 50K, right? So if you don't need 50K, I mean, there's other options there. You still work for Kiva, 5K, 10K, 0% interest loans, Kickstarter, like we mentioned. But 50K is the minimum WeFunder. And then if you raise between 50K and 124K, it's just self-reported financials.
Okay.
Then if you give 124 up to 1.2 million, then it's you need to have it reviewed by a CPA, an accountant. And if you're raising more than 1.2 million like you did, then you need a CPA audit.
An audit,
Which,
yes.
if you're a CPG company with a ton of inventory like you, then audit is a real pain in the ass to put together.
That's the hardest part, in my opinion, of the equity crowdfund is literally the audit. It's not even collecting the money from people and getting them to believe in you. It is literally the audit.
And then not for everyone. I think for most founders, actually the hard part is raising the money. You were able to do that.
Right, not me sounding
because you're so brilliant.
No, we manufacture, and that's what makes the audit so difficult, because we literally have hundreds of ingredients.
The inventory makes it really...
And then we can't stop our production. So it's like, how do we count while still producing for our retail order? Things like that. Okay. So, but I didn't know this. So up to 124, between 50,000 and 124,000, it's just self-reviewed.
Yeah.
Oh, okay. Look at that. I have a friend.
So going back to what you were saying earlier, like, who is it a good fit for, right? If it's someone that, maybe... they don't have, they're kind of earlier on, let's say, they're looking for a smaller amount.
Yeah.
Then it is totally free to launch. And, that might be a better approach for them.
Okay, that's good to know. Jonny, is there anything that, an unpopular opinion that you have about funding for your business?
An unpopular opinion. I kind of go back to what you were saying earlier. I think venture capital gets like all of the attention, all of the media. And it's kind of ironic now, because I feel like a lot of the media is a little kind of anti-tech or anti-VC, but like the only stories they write about are venture-backed startups.
Yeah.
And that consumes the entirety of the media spotlight. But the vast, vast majority of companies that are started every year in America are not a fit for venture capital. Because venture capital is like, you got to have $1 billion potential exit.
Yeah.
Right. And that just isn't a fit for the vast majority of companies. And so there need to be alternative investment structures. And so this is why we've been focused on this revenue-based financing initiative, which is like a loan-based off investment structure, which I think will be a better fit for like 99% of the companies that are started every year in America. And so I think we need, and there's institutional investors that are trying to innovate, with structures beyond kind of straight equity that VCs typically do.
And I've seen some of those, and so, like, I've seen one where you have to pay the money back, and then they still get to keep some equity. And I was like, wait a minute, I don't like this structure.
Yeah, so that's like a hybrid, like between debt and equity, and so we can accommodate structures like that as well. And for me, right, it's like you've got to be able to offer something to investors. Obviously, as a founder, like, got to have terms that aren't going to be egregiously expensive. But on the investor side, you've got to offer something to investors that's going to be interesting to them. It's trying to find that balance.
Gotcha. Jonny, is there anything you want to leave the people with? Final words.
I think just a shameless plug, right?
As if he was not shamelessly plugging WeFunder this entire time, but okay.
If you're a founder and you want to raise capital and you're curious about the idea of letting your customers invest, for me, especially for consumer-facing companies, like our dream is every consumer-facing company, every round. If you want to go the venture route, we're not kind of anti-VC, right? VCs are great. It's a source of capital, take a board seat, add value. It's great. So if you want to go the venture route, by all means, but let your customers invest alongside the VCs, behind the VCs. Then they'll love you even more and you'll grow faster.
Jonny, after our crowdfund, our community round, the first time, I actually went to look up the rules around launching my own crowdfunding site, because I'm a founder, because what else would I do? And I was like, oh my gosh, like, because, we raised like, even though some of it was reserved and some of it was actual
this
cash.
Whole time you were just pumping me for information.
Oh, man,
so you could launch a competitor.
You almost had a competitor out of me, almost.
And then you were like, oh my goodness, this is really hard to do.
Exactly. I was like, oh, they're nuts. I was like, no, not nuts. But I literally looked it up, and what was it? Because we had raised like $4 million in like 3 days. And I was like, oh, clearly I've figured something out, right? And it really was just that I had a large community. I had 100,000 customers, several 100,000 social media followers, et cetera. And I went to look up the regulation, and there was literally like hundreds of pages of documents of things you have to like do right, or otherwise the SEC is going to slap you on the wrist and like find you. And then there were like so many, like hundreds of documents you have to report every year about the people who raised on your platform. And that's when I learned that I couldn't raise my own funding on my own platform. And I was like, oh, there's no way. That was the only reason I was doing this. So I could do my own crowdfunding on my own platform next time.
Plus all the tech, right? Like WeFunder was founded in 2012, went through Y Combinator in 2013. Like, so we've been building this tech and the infrastructure and optimizing the checkout flow.
And I was just going to white label. I was just going to get somebody else's crowdfunding
No, don't do it, Kim. Stay with WeFunder.
Oh, no. WeFunder, no. I'm not doing that. I remember talking to Maxine from Caribou. I'm like, Max, I'm thinking about launching my own crowdfunding site. She's like, Kim, you don't know enough. Stop it right now. Focus on product.
I'm glad you came to the correct conclusion. So that's one thing. Like, if you're a founder, especially B2C, you're interested in WeFunder as a way of raising capital, hit us up. WeFunder.com/raise is the link. And then honestly, one more little plug. If you're listening, you're an investor, angel investing, like oftentimes it's like 10K, 20K checks. It's like not that many people have that kind of money lying around. You have to be accredited. So what we're trying to do is say it would make America better if you could 100x the number of angel investors that are investing in startups in their community, people they love. So we want to have more people, and especially, if you look at like where capital is coming from, it's all people that look like me. It's not that many people that look like you. And so if we can kind of lower the barrier to entry, and get more capital flowing to founders outside of California, New York, and Massachusetts, more capital flowing to founders of color, female founders, and empower more women of color to be angel investors, minimum investment on WeFunder is $100. So now you can be an angel investor for $100. Like, start to learn the lessons of angel investing with a much smaller buy-in. And then hopefully the bug bites, so you get really into startups, and you might kind of deploy more of your capital into startups, as well as parking it on Wall Street in a big faceless corporation that you don't really know or care about.
I'm personally a huge fan of equity crowdfunding and community rounds, mostly because, and after doing it, you guys do a great job. I think WeFunder is always my recommendation when I'm looking at other platforms. Do we do, and I'm just going to go ahead and say the names because, they're the ops, right? Do we do Republic, or do we do Start Engine, or do we do WeFunder? And my recommendation is typically always WeFunder. One, I love you guys. I was at risk of missing a payroll, and Jonny covered me, so I appreciate it. Now, that is not normal WeFunder services.
Thanks for, we'll edit that out, please.
Jonny doesn't want to
don't want anyone hitting me up. Oh, sorry, can I
no
get that same
Jonny
Kim deal?
Jonny, I was one of the first people to raise that amount of money at the time when the law changed for $5 million. And so there were a lot of things that we were just figuring out, So that was a special circumstance, and it took a special amount of time to get my round closed. But I think equity crowdfunding is what venture capital should be. I think it's that the people who buy from you should be the ones who benefit from a liquidation event, whether it's an IPO or whether it's a sale. The people who buy from you, make the brand. Why do they get nothing in the acquisition? That's crazy. You know what I mean? And most people
doesn't have to be everything. Can be a part of it, right? You can still raise from VCs,
most people don't think that their customers should get anything. You know what I mean? They feel like, well, this is my business and I do this, and it's it's such a selfish way to live life, right? But also, I think for in my opinion, VC gatekeeps money. It's like you're getting money from the rich, and you're like, okay, well, this only can go to high growth tech companies. Why is that? Because they're not the only people who can return money. They're not the only, and they're like, oh, but they can do it faster. But the truth is, more of them fail faster than anybody else. And then what happens is that money is gone, and then you're stuck there promoting your CPG companies because they're still around, because they had a solid business model that actually made money. So I feel like if you're a CPG company, CPG stands for consumer product goods, then equity crowdfunding, community rounds, that's totally up your alley, because you already have an audience and people who want to invest and are currently buying from you. Anyway, I digress. I am a huge fan of community rounds, and I recommend WeFunder all the time. So, Jonny, thank you for coming on the podcast. I love this. I love you guys so much, especially you. And I'm just so happy that we got a chance to talk.
And Kapow as well.
And Kapow.
I know Katie is your real favorite.
Katie Powers, right?
Yeah.
Katie Powers helped me close my round on WeFunder. Shout out to Katie. Couldn't have done it without her. Yeah. She's a Swiss Army knife. She knows so much about legal and accounting. The bridge of the two is an art. Yeah. Most people just know one thing. They literally go to school for years to learn one thing. When you know accounting and legal back and forth, like it's nobody's business, I'm like, where do you come from? What do they make you?
She's running WeFunder in EU now.
I was literally gonna say, why aren't you running WeFunder? Because I think you're too smart to be working with me. No offense, like you're helping me raise my $5 million round, which I'm grateful for. But literally, like you're one of the smartest people I have met.
I do think I'm biased. I do think that is one of the things we've got going for us as a platform. Like the people we have that are going to work with you on your raise, I think are just brilliant people and like good people. Like we didn't talk about this. WeFund is a public benefit corporation. So instead of a C Corp, where you're obligated to maximize shareholder returns, WeFund is a public benefit corporation. So we have a charter, which is about getting more capital flow into underrepresented founders, empowering more people to invest in startups they love.
Yeah.
And so we're actually legally obligated to uphold that charter. And so then you have a lot of people like me that maybe used to work in the nonprofit sector and kind of doing this for mission related reasons. And obviously Katie's one of those people.
Oh yeah, Katie's dope.
Now I'm digressing. Thanks for having me on. This has been super fun.
All right, you guys. Thanks for tuning in to the More Rounds podcast. I will see you guys in the next episode.